So you're living the dream, right? You're a self-employed American living abroad. Maybe you're a digital nomad, a consultant, whatever it is. It's an amazing life. But that dream can hit a wall, a really confusing and expensive tax nightmare. Okay, let's dive into one of the most critical yet completely misunderstood topics for US expats, self-employment tax. Let me ask you something straight up. You're out there, you're building your business, you're living this incredible international life, but are you 100% sure you're not paying for Social Security in two different countries at the exact same time? Because that is a very, very real risk. All right, so before we get to the fix, we really have to get our heads around the problem. And for every single self-employed US citizen working overseas, there's a default dilemma. It's like a double tax trap that you're automatically caught in unless you know how to get out. Here's the first thing you've got to wrap your head around, and it's how the US is different. See, most countries tax you based on where you live. That's called residency-based taxation. But the US? Nope, it taxes you based on your citizenship. That means your US tax bill literally follows you around the globe no matter where you earn your money. It's the one rule every expat has to understand. And a huge piece of that tax obligation is this number right here, 15.3%. Now, this is an income tax. Let's be clear. This is the US self-employment tax, your contribution to Social Security and Medicare. And it applies from the get-go. And when I say from the get-go, I'm not kidding. The filing threshold is just $400 of net earnings. Yeah, you heard me right. Not 40,000, but 400. This is what catches so many freelancers and entrepreneurs completely off guard. You make a tiny bit of cash on the side, technically, boom, you have a US tax filing requirement. Okay, so here's where the trap springs. You owe the US that 15.3%. What happens when the country you're actually living and working in, let's say it's Germany or Italy, has its own mandatory Social Security system? You better believe they're going to want their cut too. And that is the core of the problem. You're facing the real possibility of paying into two Social Security systems on the exact same dollar you earned. Now, I know what a lot of you are probably thinking. But wait, I use the Foreign Earned Income Exclusion. That covers me, right? It's a totally logical thought, but unfortunately, it's one of the biggest misconceptions out there. Let's break down exactly why that super popular tool won't help you with this specific problem. Don't get me wrong, the FEIE is an amazing tool. For 2025, it lets you exclude a huge chunk of your income, up to 130 grand from US tax. But here is the key word, the absolute critical detail. It only applies to income tax. I'll say it again, it's for your income tax, not for other federal taxes. So this leads to the big question, the 15.3% question. If the IRS says you can exclude that income for one thing, surely it's excluded for everything else, right? I mean, that would only seem fair. Wrong. And hey, this isn't just my opinion. This is a direct quote from the IRS's own rulebook, Publication 54. They couldn't be more clear about it. You have to think of income tax and self-employment tax as two totally different buckets. So the bottom line is, even if you use the FEIE to wipe out your US income tax bill to zero, you still owe that full 15.3% self-employment tax. Ouch. So if the FEIE can't save you, what can? Are you just stuck paying twice? No. This is where we finally get to the real solution. A really powerful but kind of under the radar tool designed for this exact situation. It's time to talk about totalization agreements. Okay, first things first, these are not your normal income tax treaties. They are completely separate international agreements that focus on one thing and one thing only, coordinating Social Security. Their whole reason for being is to stop that double dipping we were talking about, to make sure you're not forced to pay into two countries' retirement systems at once. The principle behind these agreements is actually beautifully simple. It just says you should only have to pay Social Security taxes to one country at a time. And the general rule of thumb for self-employed folks is that you pay into the system of the country where you're actually living and doing the work. Makes sense, right? So what does this actually mean for your bank account? Well, whether or not one of these agreements exists creates two totally different financial realities for you as a self-employed expat. Let's just put them side by side so you can see how big a deal this is. Just look at the night and day difference here. On the left, if you're in a country with an agreement, you are legally exempt from that 15.3% US tax. You just pay into your host country system instead. The catch? You have to get proof, something called a certificate of coverage. Now, look at the right side. In a country without an agreement, there's no way out. You owe the full 15.3% in the US, and on top of that, you probably owe Social Security in your host country too. There is just no mechanism to stop that painful double hit. So, where can you get this protection? Well, the good news is the US has these agreements with a lot of the places expats love to live. We're talking Canada, the UK, Australia, Japan, and most of the countries in Western Europe. But, and this is a really big but, it is absolutely critical to know which popular countries are not on that list. A lot of major business hubs for entrepreneurs, places like Singapore, Hong Kong, the UAE, they don't have these agreements. Same goes for big economies in South America like Brazil and Colombia. If you're self-employed in one of those places, that 15.3% US tax is almost certainly your reality. All right, we've gone through the problem, we've busted the big myth, and we've found the real solution. But look, knowledge is only power if you actually do something with it. So let's turn all this theory into a simple step-by-step action plan for you. Here are the 4 things you need to do. First, confirm your status. Just Google US Totalization Agreements and go to the Social Security Administration's website. They have the official list. Step 2, if there is an agreement, you need to get proof. You have to get that certificate of coverage from your host country's Social Security office. That's the piece of paper that lets you legally claim your exemption from the US tax. Third, if there's no agreement, you just have to face the music and plan for it. Budget for that 15.3% tax. And finally, number 4, no matter what your situation is, you have to file. If you make more than $400 net, a US tax return is required, period. You know, at the end of the day, this isn't just about saving some money on taxes this year. It's about a much bigger question. Where are you building your retirement benefits for the future? A totalization agreement isn't just about avoiding double tax. It helps coordinate your coverage. So the real question you need to be asking yourself is, where are my contributions going? And is my host country actually protecting my long-term financial future? Finding the answer to that question could be one of the most important things you ever do as a self-employed expert.